Hi, good morning, and welcome to the quarterly market update from Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown and Cody Demmel. Good morning, guys. How you doing?
Good morning. Good.
Great,
How are you?
Good. So we're seeing a lot of familiar faces this morning, some new people joining us here for these quarterly updates that we like to do. We're live and without a net this morning, so we encourage you to write questions in. This is an interactive conversation. It's a difficult time here in the investing markets, and just by way of introduction, Morton Brown Family Wealth is a firm rooted in the planning process and really helping people become good stewards of their wealth. And our purpose in these sessions is to educate you on topics that are going to help you to be a better steward, to help you make purposeful decisions in planning and investing for you and your family. So with that in mind, we're going to start by updating you on what's happening in the markets, specifically with bonds. If there's anything we've learned in the last so many years, it's that bond piece of the portfolio, that ballast that's supposed to be there for the stock side, is one of the most misunderstood aspects of people's financial situations. So we're going to spend time on income, yield, fixed income, and all of those implications because it's a really fast-moving space. But then, Katie, then we're going to talk about your financial plan and specifically your goals.
Yes. One of the most common questions that we've heard this year is, am I still on track? Am I still okay? So we want to talk a little bit about goal setting at a time when you may be feeling as though you're falling behind. Sometimes it's okay to move those goalposts. Sometimes it's okay to adjust your goals and think about maybe changing a little bit of a direction. But when you do that, we want to make sure that we're helping so that you're doing it from an informed and confident place. I think that's the biggest thing is making sure that you understand the moving pieces if you were to adjust your goals. But we're going to get into that a little bit. So
yeah, we're provide some reading material too. That's always good. There's homework involved, which is always good. Yeah. All right, but first we're going to talk about the third quarter that was, and we're kind of 3 quarters into a pretty dramatic pullback in the stock and bond markets. So again, this is interactive. If you have questions about something that we're not covering, or you want us to go deeper on a particular topic, feel free to post questions in the chat, and we'll be happy to answer what you have. So Cody, why don't you kick us off with some of the things we want to cover here, especially on the side.
Yep. So as Dennis said, we're going to go over a review of what happened in the third quarter. So this slide is just an overview of some of the positive signals that we see going forward, and then also some of the reasons for potentially some concerns going forward too. And we'll dive deeper into each of these areas as we go through the presentation. So some of the positive signals is fixed income yields, as Dennis said, are the highest they've been in years. Just with the rise in interest rates, fixed income yields are now the highest that we've had in 10 plus years, and we'll go deeper into that. Headline inflation did come down in September, even though it's still high at around 8%. It is off the lows that we saw in June. And then, as Dennis said, the equity and fixed income valuations are more attractive now that we've had a decline in this year than where we were at the start of this year or even at the middle of last year. And a 3.5% unemployment rate that we have right now is not consistent with some of the other recession or economic downturns that we've seen in the past. And some of the reasons for concerns looking forward is obviously, as everybody knows in news, there's no shortage of negative headlines, including inflation that's still high, even though it is slowing down and hopefully will continue slowing down going forward. But with that does usually mean that the economic growth is slowing down too. But that does have to happen to hopefully slow down inflation back to that 2.5% that they're targeting. The war in Ukraine is obviously still going on. Energy challenges both in Europe, but also we obviously know gas prices here in the US are higher than they've been recently too. COVID is still around. It's obviously a lot better than where we were even last year or back in 2020. And then lockdown. China has lockdowns, which could affect the supply chain as it did over the past couple of years too. And then the one other major concern that a lot of people are talking about is, what if the Fed does raise interest rates too high? And not only just the Fed, but what about other central banks around the world too, if they raise the interest rates too high and push us into a recession? And then obviously going back to the Ukraine war, what does Russia do from where we're at right now?
I think both on the positive and negative side, one of the things you'll see us highlight today is it's not the direction of things this year that's been so extraordinary, or even let's call it the last 3 years. We've seen economic declines, we've seen inflation before. It's the pace. Everything's happening so fast, and the Fed response is happening so fast. When you move fast, that's when things become disjointed a little bit. So I think that's one of the things to spotlight.
Yeah, and this slide is just a pretty basic slide that we like bringing up, that just goes over, don't let the emotions drive your investment decision. So whether you see a negative headline and you start thinking negative, normally when people are getting to the fear factor, it's actually when you should be buying into investments, as everyone always wants to do. You want to buy low, sell high. But what this goes over on just a very basic overview is normally at the top, when people are feeling best, this is when they want to buy more. And this is actually when you should do some rebalancing and move the investments back to your strategy. And the same at the bottom, this is when you can do some rebalancing when you're feeling the worst, to potentially rebalance into some stocks too, if you have a long time horizon.
Yeah. And I think we've, especially over the last 12 months, call it the last 15 months or so, we have really seen the whole, this whole chart right here, thinking back to the summer of last year, there was definitely a lot of excitement for opportunity, and people were interested in, what are those things that are going to make me a lot of money quickly? A lot of people kind of diving in, and then we've witnessed that nervousness starting to come through, and quite honestly, the fear too. I think we're going to get into this a little bit, but we are really kind of sitting right around in this bottom area. The challenge is you never know how long each of these areas are going to last. We can recognize maybe where we're at, but then we still have to have patience and discipline to kind of move from one spot to another.
Yeah, this chart looks really graceful, but truth be told, I saw all of these yesterday. So, I mean, it happens very quick, Yeah. Cody, show the next chart. This is the reality. This is what it actually looks like from a fear and optimism, exuberance.
Yeah, so this is actually data points that are going over the consumer sentiment index and what the possible next 12 months return were. So if we look at the bottom, and we actually hit the all-time low earlier this summer, we bounced a little bit from there, but again, we're still pretty much at the low points that we've seen in consumer sentiments. But if you look at the bottom numbers and then the plus percentage that you see, so for an example, in 2020, that plus 43% means at the bottom here, the S&P 500 was up 43% over the next year. At the bottom here in 2011, the S&P 500 was up 15% over the next year, so on and so forth. If you look at the 8 troughs, the average year return after the trough is around 25%, where at the top, when people are feeling the best, the average year return in the S&P 500 is only around 4%. So as we were saying, go ahead, Dennis.
Well, I was going to say, Katie, wasn't this a tough conversation last year when we started talking to people about lower expectations as the markets got higher and higher? As we're doing the planning process, we're saying, all right, let's ratchet back our expectations for future returns because prices are so high. And now, Cody, to your point, we should probably ratcheting up future expected returns because of being low. It's counterintuitive, but it's a really important concept.
Yeah,
absolutely. Yeah, and I think we're going to dive into that even a little bit.
Yeah, we'll dive into that a little deeper into the presentation too.
Yeah, there are some silver linings today. We want to make sure we emphasize that. There are definitely silver linings.
Yeah.
All right, this graphic I think is really interesting because it speaks to what the Federal Reserve is trying to do. So the Federal Reserve is, racing forward. As we talked about the pace of rising rates, they're racing forward, and you see all of those obstacles out there in the windshield. It's everything from new home construction, market volatility, earnings guidance, all those things that are out there forward looking. But the Fed is looking backward at, unemployment, which is still really, really low. CPI, which is still really, really high. All of those are backward looking numbers. And you're trying to navigate forward while the only information you have is in the rearview mirror. And that's a really imagine running your own finances that way. If you're making every, expected financial decision based on backward-looking information, really challenging to do. But the other thing I think is interesting about this graphic is look at the speedometer. The speedometer is like, pedal to the metal. And again, that's the real challenging part is that we're racing forward at a really fast pace. It makes the odds of some sort of mistake one way or the other and the Fed's kind of opting for making a mistake on the side of curbing inflation, not necessarily avoiding recession.
Yep. So as Dennis was starting to get into, and as we said, one of the reasons for concern is obviously still the high inflation number. So this just goes over the inflation numbers going back 50 years to the 70s, where we obviously had higher inflation, and then it's been very low since then. But now, obviously, as everybody knows, we've had that spike up in inflation here over the past year. And the reason we're trying to curb this is by, as Dennis said, raising the interest rates, which this slide goes over just the pace and how fast interest rates have rise over the last 12 months. So this is the fastest rate that the Fed has started to raise the interest rates since back in the 1980s.
Mm-hmm. Yeah, and all of this, it could take some time to show up. There's kind of the action and a delayed response. So there's patience is a really difficult thing, but it could take some time for that to actually show up in the inflation figures. And there's so many inputs. We covered that last time in our quarterly update. All of those components, whether it's the housing or rent or used cars or healthcare, all of those things, they respond at different paces to the stimulus of higher rates. So I think it could take some time.
Yeah, and we do expect that there will continue to be rate increases. I think we're expecting another 75 basis points probably coming up here before the end of the year. And there may be another one of that magnitude afterwards as well, if they don't start to see some of those inflation numbers come down. But to your point, Dennis, that's the challenge, is that it takes time to trickle through and have the impact that they want it to have. So it's a balancing act for sure.
Yep. So this slide just goes over how fast we've moved, especially in the short term interest rate market. So just at the beginning of this year, a 2-year treasury was around 0.3%. Right now, if you buy a 2-year treasury, you can get a 4.2% yield, which again, this is obviously why the bond prices have declined this year, because when interest rates go up, the bond prices go down. But the one positive thing about this is now we're actually able to get some yield, and we'll go into this a little bit deeper in a little bit. We're actually able to get some yield on some safer investments now, compared to where before we had to get a lot of the returns from equities, but now we can actually get some yield from fixed income.
Yeah. But I think the other thing that really jumps out is that it's, we see, so this is where we're at right here, September 20. Can you guys see my pointer?
Yeah.
Okay, great. This is where we're at here. And this is 12 months ago down here. This spike up here and then flattening and actually inverted. We're seeing the Federal Reserve, just a reminder, they only manage the short term end of the curve. They that very beginning part, when they raise rates, that's what they're beginning. So that's why that's what they're doing, is just on this front end. So that's why we see the huge spike on the front end. And then it's up to the market to decide what to do with it. And so when we see this inverted curve here, if you're looking out at 30-year treasuries, actually less than 2-year treasuries, that's the market saying there are still a lot of concerns here, and maybe concerns that the Fed might be moving too fast. And once we get out of this inflationary period, they might need to actually start to drop rates down again to boost the economy. So that's something we pay attention to for sure.
And kind of to bring this back to financial planning as well, guys, this is a sea change for financial plans, right? I mean, for the last 15 years, we've been discounting yield from anything safe, and just the risk-free rate of return has been next to zero for so long. When this jumps up to 2, 3, 4%, the calculus for financial decision changes completely. So I think it's a really good time to be revisiting, schedules for paying down debt, schedules for where to put cash, how to think about where retirement income is going to come from. All of that is changing so quickly. So I think it's a really good time to be revisiting goals, planning, and we're going to cover that a little bit. But it's hard to understate how much of a sea change this is from the last 10 years.
Mm-hmm.
So this chart, and sorry if we seem like we're rushing through some of these, but we have a good amount of information to go through, and we want to try to keep it to 30 minutes as much as possible. But this chart goes over the fixed income returns year to date. So if we look at the longer term bonds, so the 5 to 10 year US Corp are almost, so the US corporations, the bonds that the US corporations are putting out are almost down 18% year to date. But if we look at the shorter term bonds, so again, before where they were yielding very little. Now the yields bumped up. These are not down as much just because you're not taking on the duration risk that some of these longer term bonds have. So that's why the shorter term bonds are not down as much on a percentage wise as the longer term bonds.
And Cody, you touched on something there. This is a duration challenge right now. It's the length of the bonds more than anything else as the Federal Reserve increases the rates. This is not a credit challenge as much. And so, it's very different from like the financial crisis, for instance, when we were concerned about companies going out of business. For the most part, companies continue to be pretty healthy. Now, they might start slowing down as rates go up because that's the intent of the Federal Reserve to slow some things down. But we're still sitting at a pretty healthy spot. So this is very much reactionary to the Federal Reserve moves.
And then, so this is just a quick chart just showing not only this year has been painful for stocks, but this is how painful it's been for the fixed income investors. So this line on the bottom is the Barclays Aggregate Bond Index, which goes over all the bonds. They're down around 14% year to date, which is, as you can see on this chart, the worst year so far that we've had in bonds. I mean, we could see a bounce back if they don't raise interest rates as much as expected later this year. But if we look at the average, there's still potential for some good years going forward, even though we've obviously had a pretty negative year this far in fixed income because we started from such a low interest rate to now we're actually getting some yield on the interest rate. And that's why we've had such a decline in actual value of the bonds.
Yeah, and you see that snapback, one of the best years in history was coming off of another massive increase in interest rates early in the 80s. So, for people who think, should I be buying the dip on the stock market? How do I deploy cash? Don't discount the opportunity that could exist to capture higher yield and lower prices on bonds. I'm going to pause here just for one quick question, and thanks for the questions that are coming up. So regarding Fed increasing interest rates, it seems like should they pause? Should they wait and see how things shake out? I think that's part of the challenge is that the lesson for the Federal Reserve through the great financial crisis that then was applied during the pandemic was don't be too reluctant to move quickly and and do a lot early on. I think the lesson for the great financial crisis in 2007 and 2008 was the Fed didn't move quickly enough and with enough force to kind of solve the issues. And they've applied that lesson repeatedly over the last 4 or 5 years to say, we're going to do massive stuff really quickly, and we'll worry about, peeling back later on. So could they be making a mistake as the pendulum swings the other direction? Possibly, but it really seems like they're applying the lessons from previous crises in not looking backward and being willing to go the extra mile.
So this chart just goes over one of the positives that we've seen now from going from such low interest rate environments to where we're at now. If we look over, this goes from a 10-year range from U.S. Treasuries, municipal bonds, and some other fixed income environments right now. So this blue diamond is where we're at now. We are at the highest yield that we've been at in the last 10 years for fixed income. So as Dennis said, if you have some cash sitting on the sidelines, now may be a good time to put some of that to work in a safer investment like bonds. And
that the yield to maturity of your bonds when you buy is a pretty good predictor of where your returns are going to be. So that's one of the more reliable places to say, what can I expect out of this? That yield to maturity.
And then, so as I'm sure everybody knows, this has been a painful year, not only for fixed income, but for stocks. So this chart goes over the stock returns that we've seen year to date from the US indexes, which are the red, which is the S&P 500, and then the NASDAQ, which is the more growth oriented technology index, which is down around 30%. And then we also have the developed markets and emerging markets in here too. So the whole world has been hit so far on the stock side of investing. But there is some positives when we look forward from where we're at now, and kind of going back to some of those first charts that we went over, is the bounce back that you can see coming out of a bear market. And again, we're not saying that we're out of the bear market yet, but if we look forward, we know now we're a lot closer to the bottom than we were at the beginning of this year. So if you look at this chart, this goes over what return we would need to get back to the peak that we saw in January. So if you think we're going to go back to all-time highs, which we have every single time we've gone into a bear market before, just depends on how fast we get back to that. But say if we look at a 3-year, it takes 3 years to get back to the all-time highs. The average return that you would get on stocks is 12%. Even if you look at 5 years out, the average return is almost 8% that you would get if we went from now back to the all-time highs.
Yeah.
No, I love just even the title. Oh, sorry, Dennis.
No, go ahead.
I love even just the title of this: bear markets lead to bull markets. Just to kind of keep that frame of mind in place. Like eventually there is a more optimistic market ahead of us, and eventually we will see those returns. I mean, even and I think we had gone over other charts previously before where the average recovery coming out of a bear market could take up to about 40 months. Well, at that point, you're still looking at about 10% annualized returns coming out of that. Even if it takes, 3-4 years. So we just say that with the caution of, yes, there are some cash alternatives, but don't abandon the plan to go pick up all those cash alternatives. I'd hate for somebody to totally abandon the strategy and lock themselves in something far less than what the opportunity to recover would be if you were to stick with the strategy that's right for you.
Yeah, that comes back to that sentiment chart that we were looking at. How's it going to feel at the bottom? Pretty awful. It's going to feel rotten. What's the outlook from the place where it feels pretty awful? That's the reality of it.
This is kind of another chart going over that too. So if we think back to that sentiment chart at the top, the average returns over the next year were only 4% on a yearly basis. But if we look at the bottom ones, when it's feeling the worst, the average return is a lot higher at around 25%. So what this chart goes over, and if we focus on the right side, the 5-year annualized return of the valuations of stocks from where we're at now is 15. The PE ratio is 15, where last year we were a lot higher at around 21. And the average 5-year return that you can look at when you have a PE ratio around now is around 10%. Where last year we were looking at a average 5-year return at 0. So as Dennis and Katie said earlier, when we have the valuations and where we were at last year, your expectations for future returns should be a lot lower. But when we have the bear markets and the valuations come down, the expectations for future returns should be a lot higher. And this goes over the history of the S&P 500.
Yep. Lower valuations, higher returns. It doesn't always make sense in the moment, but long term, that's the effect.
And this chart just goes over, so this is a calendar chart. We normally bring these up on a yearly basis, but we thought bringing it up this time on a monthly basis, just because, as we said earlier, everything is moving so fast this year. Both on the upside, we had some bounce backs in some of the months, but then right after it came back down. This just goes over, even if we just focus on emerging markets for this year, you can see at the beginning of the year, it's top, then it's bottom, then it's top, then it's bottom, then it's top, then it's bottom. It just bounces all over. And there's no pattern that you can see. And even if you look at US large cap, it's the same thing. So it was the bottom at the beginning of the year, then we had a bounce back, then the bottom, bounce back, so on and so forth. But this is why we don't want to try to time things. And if we look at it on a longer term basis, you can see that if you just stay to your investments, and this is obviously equities, you are expected to get a higher return, just staying course.
Yeah, I don't think we need to be too clever in trying to, time things, pick sectors. I think being well diversified has helped a little bit this year, but it helps a lot on the bounce back because we don't know what's going to lead us out. So own a little bit.
You want to skip forward to slide 17?
Sure. There we go. All right. So at this point, we're going to pause for a second, and we're just going to spend a little bit of time talking about planning goals. Recently, Katie and I read through a new book that came out by Annie Duke, who's a former professional poker player. We've written about some of her books before, but her new book is entitled Quit: The Power of Knowing When to Walk Away. Now, we picked this up thinking it was going to be related to the Great Resignation, people just stopping what they're doing and starting something else. but there's actually a really good discussion on the pursuit of goals. And at a time when we're all kind of persevering through a lot of challenges, we're kind of gritting our way through this. She asks important questions about the things that we chase in life and what we're willing to endure to get to our goals. And there's a financial implication to that. Right, Katie?
Yes, yes. She highlighted different examples of, people running marathons or climbing Mount Everest, and how much, you set that goal out there, and how fixated you become on it, and how much you're willing to risk and give up to get to that point. And at some point, you may need to reevaluate the situation. So that's kind of the extreme, and Everest and marathon runners. But then we think about us as investors and counting a year like this, like it feels extreme. And you might be second guessing financial plans and wondering, all right, is all of this like grit that we're dealing with this year, is it worth it? But instead of thinking about quitting and abandoning the plan, it might be a good time to think about the progress that you've made along the way. Rather than saying, all right, how far am I from my goal out there? Think about how far you've come over the past few years. We often talk about we will never have a normal year in the markets. We're never going to have that assumption year, that 5%, 6%, whatever you're using in your plan. It's always going to come through, peaks and valleys. And so it's okay to re-examine goals, but it just needs to be done from a place where you have a good understanding of the impact of that, and a place where you're acknowledging, if you're, once again, a marathon runner and you're trying to run a marathon, if you got into mile 18, maybe you didn't reach mile 26, but how much better of a healthy lifestyle have you built into, your daily activity? So give yourself credit for how far you've come. And I think that's just where we want to kind of go with this a little bit today.
Yeah, I want to pull up this quote here. She starts out with an analogy of the Everest climb. Some of the people who unsuccessfully, there have been a lot of catastrophes in trying to reach the summit to Everest. But the real goal in climbing Everest is not to reach the summit. It is understandably the focus of enormous attention, but the ultimate goal, in the broadest, most realistic sense, is to return safely to the base of the mountain. And I think sometimes, we, in talking with clients, sometimes there's a fixation on the peak value of my portfolio, or a number that I have in mind, that I need to have X dollars. And sometimes you need to step back and say, wait a minute, what is actually the goal? Is it to sustain a lifestyle? Is it to leave a legacy? Is it to just, what are the qualitative things that you're trying to accomplish? And if those things can be accomplished, does it diminish the meaning of that arbitrary, random goal? Does 26.2 in a marathon become arbitrary? Does the peak of the mountain become arbitrary if the real goal is something more meaningful to you, right?
Right. Absolutely. And I think that's a good point too. Like when we think about, sometimes people do put out specific goals. I need to have X amount of money. Well, why? What is the purpose of that money? What is the real goal that's underlying that? Is that because, you need a certain amount of money to feel confident, or is the real goal that you want to live comfortably, you want to take care of your family, and that number may change constantly? And I think that's one of the things that she points out in her book, is she really warns against, fixating on a specific thing in a constantly changing world.
Mm-hmm. Right. Because there's the whole reason we start out, like, flash back to when you're in your beginning of your career, beginning of your investing career. And the whole reason you do this is so that you can have quality of life. But suddenly that gets morphed away into, no, I need to beat the market, or I need to achieve a certain, it dissipates over time. And it also, one of the downsides to goal setting is you become so focused that you can't see other paths. And I think that's an important role for us as advisors. And one of the things that we try and do is spotlight the blind spots, that if you're so fixated on a particular goal, did you ever consider looking over here? Or maybe and one of those off ramps that maybe you could accomplish it without taking on more risk, or without, just a different framework.
I liked the concept of unlesses. And she really highlights that inside of the book too. Like, this is my goal unless this happens. I plan to run a marathon unless I break my leg. And that might seem silly, but those are actually some very specific examples that she had. There are a number of examples of marathon runners that continue to run the marathon after they broke their leg around mile 8, for
Is
instance.
that crazy? Yeah.
It is totally crazy, but I get a piece of that, like and I understand a piece of that, but when you look back, it's one of those things that, like you said, it's difficult to see it in the moment, but when you reflect back upon it, you're like, that was crazy. Why would I do that?
Right.
So I think the idea of building in unlesses on the front end to really permission yourself, if something happens, then it's okay to change the plan. And they could be even positive things. Like you might say, I plan to retire at age 65, unless I'm loving what I'm doing, then I'm going to keep working. That's a great one. Or I want to leave a legacy unless, I need that money to make sure that the quality of my life and my spouse's life is where we want it to be. Then maybe I won't. And that's okay. Like that whole idea of permissioning yourself at the front end.
Yes. Yes. And, tying this into financial planning, your financial plan is a living, breathing exercise, and it can't be fixated on one spot. There have to be those check-ins, those off-ramps and everything else. And it's important, especially right now, because if you've been invested in stocks or bonds, odds are you're down somewhere from where you were at the beginning of the year. So we're going to pull up one more quote here to leave you with today. And that is this one. This idea of being behind or being in the losses, as Annie Duke puts it. Being in the losses is as much a state of mind as anything else. We don't see ourselves as being in the gains, even though we've gone farther than where we started, because we're not measuring ourselves by how far we are past the starting line. We're measuring ourselves by whether we're short of the finish line. So if you're looking at your statement, you're feeling behind, that's going to happen. There are times when you're just not as far as you want to be or as you will be in the future. But think of how far you are from where you were, and then think of the opportunities that lie ahead. So hopefully we've helped to talk a little bit this morning about some of the silver linings and opportunities. There are higher interest rates, yes, but it changes the math for savers. It changes the math for retirees. And it really reiterates the importance of financial planning to come in and say, how does this change my circumstances? And what are the things that we can do constructively to make the most out of this opportunity?
Right.
All right. Well, thank you for joining us this morning. We tried to keep it to 30 minutes, and we're just about time. So thanks for joining in. If there's something we can answer specifically, if there are questions that you have for our team, feel free to reach out to us. This is a great community, and we're really appreciative of everyone joining us this morning. We wish you all the best this fall and look forward to catching up with you next quarter.
Thank you, everyone. Take care.